Now, for commodities. Commodities occupy a unique place in this story. They are not merely investments, they are inputs into the global economy. Oil fuels transportation, copper powers electrification, natural gas heats homes, gold serves as both jewelry and a store of value. When interest rates remain high, commodity markets often receive conflicting signals. Slower economic growth may reduce demand, but geopolitical events, weather, and supply disruptions can push prices sharply higher regardless. That's exactly why central banks remain so cautious today. Recent energy market volatility reminds policymakers that inflation doesn't always originate inside the economy. Sometimes it arrives on an oil tanker, or through a disrupted shipping lane, or from geopolitical conflict thousands of miles away. The European Central Bank specifically highlighted elevated energy price uncertainty as one of the key reasons for maintaining a cautious meeting-by-meeting approach. And then, this is very interesting. There is cryptocurrency. Perhaps no asset class illustrates changing financial conditions more dramatically. When money was exceptionally cheap, investors eagerly pursued higher risk opportunities. Cryptocurrencies benefited enormously from abundant liquidity, but crypto has matured. Institutional participation has expanded. Large asset managers now monitor blockchain developments almost as closely as macroeconomic conditions. Higher interest rates don't determine Bitcoin's future, but they absolutely influence investors' appetite for risk. And that's why every Federal Reserve press conference, every inflation report, every employment release can ripple through digital assets within minutes, if not seconds. Bitcoin was once viewed almost entirely as an isolated technology story, but today it's increasingly part of the global macro conversation. Liquidity matters, interest rates matter, dollar strength matters. The crypto market still has its own unique drivers, but it no longer lives on an island. Now, here's the remarkable thing. Stocks, bonds, real estate, currencies, commodities, crypto, they may appear to compete with one another, but in reality, they are responding to the same heartbeat, monetary policy. And right now, that heartbeat is steady. Understanding why central banks are waiting is only half the story. The real opportunity begins when you know how to position your portfolio, whether rates stay high, start falling, or surprise everyone once again. And that's exactly where our story goes next. If there is one thing financial markets dislike, it's uncertainty. Unfortunately, uncertainty is exactly what investors have today. Ask 10 economics where interest rates will be a year from now, and you may receive 10 different answers. Not because they are uninformed, but because the economy itself is standing at a crossroads. Inflation has slowed, growth has moderated, labor markets are cooling in many countries, but not collapsing. Consumers remain cautious, yet continue spending. Businesses are investing, especially in artificial intelligence. Meanwhile, geopolitical tensions, government spending, trade policies, and energy markets continue shifting almost every month. The truth is, there isn't one likely future. There are several, and smart investors don't build portfolios around a single prediction. They prepare for multiple possibilities. Let's explore the 3 scenarios that could shape the global economy over the next 12 months. Scenario 1, the soft landing. This is the scenario policymakers have been hoping for all along. Inflation continues drifting toward target, economic growth slows but doesn't contract. Companies continue hiring, although more cautiously. Consumers keep spending without fueling another inflation surge. Central banks finally gain enough confidence to begin reducing interest rates gradually. Not because the economy is weak, but because inflation is no longer the dominant threat. Think of it like taking your foot off the brake rather than pressing the accelerator. So you're not pressing the accelerator, but you're just taking your feet off the brake. Growth doesn't suddenly explode. It simply becomes easier for households and businesses to borrow. Now, Mortgage costs ease, corporate financing improves, but business investment accelerates, consumer confidence strengthens. Historically, this has been one of the more favorable environments for diversified investors. Stocks often benefit as borrowing becomes cheaper. Bond prices usually rise because yields decline. Real estate begins recovering as financing improves. Smaller businesses gain easier access to credit. Risk appetite gradually return. But even in this optimistic scenario, central banks are unlikely to rush. After spending years fighting inflation, they won't want to risk repeating the same mistakes of history. Rate cuts would probably be measured, predictable, and carefully communicated. Imagine hiking down a mountain after reaching the summit. No one sprints downhill, especially after remembering how difficult the climb was. Scenario 2: higher for longer. This may be the scenario markets are increasingly preparing for. Inflation refuses to completely disappear, not because supply chains break again, but because wage growth remains resilient. Services inflation stays elevated. Consumers continue spending more than expected. Artificial intelligence investment boosts demand across multiple industries. Government spending remains supportive. Economic growth slows, but never weakens enough to justify lower interest rates. In this world, central banks simply wait. Month after month, meeting after meeting, the phrase higher for longer remains the defining message. Financial markets initially become frustrated. Investors repeatedly expect rate cuts, only to push expectations further into the future. We have already seen versions of this happen several times over the past few years. What are the consequences? Cash continues earning attractive returns. Government bonds provide meaningful insights. Companies with weak balance sheets remain under pressure. Businesses with strong cash flows continue outperforming. Stock markets become increasingly selective. Instead of everything rising together, investors reward quality, efficiency, profitability, pricing power. This environment doesn't necessarily mean poor investment returns. It simply means investors must become more selective than they were during the era of ultra cheap money. Easy money made everyone look like a genius, but higher interest rates separate strong businesses from weak ones. Scenario 3: inflation returns. This is the scenario central bankers fear the most. Not because it's the most likely, but because it would be the most difficult to manage. Imagine inflation falling steadily, encouraging investors to celebrate. Then, a geopolitical conflict disrupts global energy supplies, or major shipping routes become restricted, or food prices surge after severe weather, or labor shortages intensify unexpectedly. Inflation begins climbing again. Suddenly, central banks face an uncomfortable choice: accept higher inflation or tighten policy once more. History tells us that they would likely choose the latter. Markets would immediately begin repricing. Bond yields could rise again. Highly valued stocks might face renewed pressure. Mortgage costs could remain elevated. Currencies would react rapidly. Commodity markets would become increasingly volatile. Crypto, already one of the world's most volatile asset classes, could experience another period of dramatic swings. Will this resemble the inflation shock of 2022? Probably not. Economic history rarely repeats itself exactly, but it often rhymes. That's precisely why policymakers remain so cautious today. They are not merely fighting today's inflation, they are trying to prevent tomorrow's inflation. Notice something interesting? All three scenarios have one thing in common: none of them predict certainty. And that's perhaps the biggest lesson investors often overlook. Successful investing isn't about perfectly forecasting the future. It's about surviving whichever future arrives. Legendary investors have always understood this. They diversify, they manage risk, they keep adequate liquidity, they avoid excessive leverage, And perhaps most importantly, they remain emotionally disciplined when headlines become dramatic. Markets will always produce surprises. That's not a flaw, it's a feature. The future has never been certain. Only today's headlines make it feel unusually unpredictable. At the beginning of this story, we asked one simple question. Why are so many of the world's central banks holding interest rates steady? After traveling across continents, through history, through inflation, and through financial markets, the answer is surprisingly straightforward. They are waiting for confidence. Not confidence that inflation is lower today, confidence that it will remain lower tomorrow. That patience may appear frustrating. Markets dislike waiting. Businesses dislike waiting. Home buyers dislike waiting. Politicians certainly dislike waiting. But monetary policy has never been about satisfying today's headlines. It's about protecting tomorrow's economy. History reminds us that moving too quickly can be just as dangerous as moving too slowly. And today's policymakers carry decades of lessons on their shoulders. From the inflation shocks of the 1970s to the global financial crisis of 2008 to the COVID pandemic of 2020, every generation has left its mark on the central banking playbook. Now, another chapter is being written. One meeting at a time, one inflation report at a time, one employment report at a time, one cautious decision after another. Now, for investors, perhaps the most important takeaway isn't predicting the next interest rate decision. It's understanding the forces behind it. Because once you understand why markets move, temporary volatility becomes easier to navigate. Headlines become less intimidating. Short-term noise becomes easier to ignore. The greatest investment advantage has never been knowing tomorrow's news before everyone else. It's having a framework that still makes sense after tomorrow's news arrives. Whether rates begin falling, remain elevated, or surprise everyone once again, the principles remain remarkably consistent. Stay diversified, stay informed, avoid emotional decisions, think in years, not weeks, because wealth is rarely built by reacting to every central bank meeting. It's built by making disciplined decisions consistently over time. If you found this commentary valuable, kindly like and subscribe to B Dollar Finance. Every week we break down the world's biggest financial stories without the jargon, without the sensationalism, and with one goal: helping you become a smarter investor in an increasingly complex world. Because in finance, knowledge compounds. Thank you for watching. We will see you in the next one.